Good evening to one and all. This is Anup Shaha, and today we are here classes. So before starting with the technical topic, I'll give you a brief of what Professional Forum is all about. Professional Forum was a WhatsApp group started way back in 2016 by Omkar Sabne, Ameya Limay, Ishan Shaigran, Nikita Butada, and work from home that we are all doing. We taught a unique way to continue the knowledge sharing part, and that is we started with webinars. The webinars are scheduled. The timetable I'll give you at the end of this video. Further, we have also started with our very own magazine, and there are many activities scheduled that will help each and every one to link professionally and to update their knowledge. So, with this background, I would like to start with the technical part, that is seminar on amendments to Finance Act 2020. So, Finance Bill was introduced in Parliament on 1st February 2020. In the passage, when it was passed in the Parliament on 23rd March 2020, there were several amendments that were made, and they were very significant ones. Today, what we will do is we'll discuss few significant amendments that were made to this finance bill, clause by clause. We'll also discuss with the implications of the same. The very first amendment, not only in the Finance Bill 2020, but also in the original bill as introduced, it was about NRI and the residency status, that is Section 6. First, we'll speak about Section 6(1)(a), that was newly inserted clause, and which was a very important clause that was inserted. Section 6(1)(a) speaks about deemed resident. So what I will do is, I will read out the verbatim copy of the finance bill as introduced in the parliament, and then we will come to the amended portion in clause 1. Now clause 1 of section 6 speaks all about 182 days or more, 365 days or more in the preceding 4 previous year, or 60 days in the previous year, and all that stuff. So notwithstanding anything contained in clause 1, that is non-obstinate clause, an individual being a citizen of India shall be deemed to be resident in India in any previous year if he is not liable to tax in any other country, if he is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. So what does this section clause says? That a person who is a citizen of India, an individual, he shall be deemed to be a resident of India if he is not liable to tax in any country or territory due to his residency, domicile, or any other nature, any other similar nature. Now, this had a huge impact on individuals who are not having liability to pay tax in any other country. They were deemed to be resident in India. However, there was a major change while this clause was passed in the parliament, and I'll read the verbatim copy of it and we'll compare it. So, notwithstanding anything contained in clause 1, this is same non-obstinate clause, nothing contained in clause 1 shall apply to this section. An individual being a citizen of India, again an individual who is a citizen of India having a total income. So now this is the operative part that I would say, which is very important part. Having total income other than the income from foreign sources. So foreign sources income is shall this only then this person, this individual shall be deemed to be resident in India, and if he is not liable to tax in any other country or territory by reason of his domicile, all that stuff. So the important part here is that the person, that individual, his income, his total income in India should not exceed rupees 15 lakh. However, this income shall exclude the income from foreign sources. So this was a major relief per se for these individuals. So if their income is below 15 lakh, then the old provisions will apply. That is, no provision will apply to them, even though they are not liable to tax in any other country or any other territory, or by reason of his domicile, residence, etc. But if their total income goes above rupees 15 lakh, then they will be falling under the mischief of section 6. There is an explanation that is given. For the purpose of this section, the expression income from foreign sources means income which accrues or arises in outside India. But obvious income that accrues or arises in India will be income that is earned in India in view of Section 9. So any income that accrues or arises outside India, this income shall be not excluded while computing that component of rupees 15 lakh. Now, important point here is not all foreign income set up in India. So if there is any business that is controlled in India and the income is earned in a foreign country, or is the profession is set up in India and the income is earned in a foreign country, then this shall be included for computation of that rupees 15 lakh. So if a person X, he has an income of rupees 5 lakh from a business controlled in India, and he has a taxable income in India of rupees 11 lakh, then he shall fall under the mischief of section 1A, section 6(1)(a). Now the next part is, what is total income? Total income is any income that is taxable in India. So if a person is earning any exempt income in India, then that will be not considered in the total income, and that will be not a part of rupees 15 lakh that has to be computed. So important point here is total income is taxable income. All the foreign sources income has been excluded except income derived from a business controlled in India or a profession set up in India. So this is a major amendment to the Finance Bill 2020, Section 6(1)(a), 15 lakh additional component is added. Explanation said, there is Section 6(1) subclause C, which says that if a person is a resident in India, if and only if he is staying in India for more than 182 days, that is A, and the C1, if he is staying in previous year for 60 days, and if he is staying in preceding previous 4 years for more than 365 days, then and only then his residence. However, there was exceptions to this. The first one we all know, that is crew members. The second amendment is that if a person is an Indian citizen, individual, or he is a person of Indian origin who comes to India on a visit and normally he stays outside India, then that 60 days will be converted to 182 days. The original Finance Bill 2020 made an amendment to this, that this 60 days, this 182 days shall be substituted with 120 days. So now a person, if he stays in India for more than 120 days and in preceding previous 4 years for more than 182 days, and he is a person who is person of Indian origin, then he will be deemed to be a resident of India. However, there was a change on similar lines as we discussed in section 6(1)(a). Now the amendment part is such that when such person, if he is earning total income other than income from foreign sources of rupees more than 15 lakh, then and only then this 60 days, 182 days as given in explanation shall be converted to 120 days. Otherwise, for all the citizens or person of Indian origins who are outside India and come to India for a visit, this 182 days shall remain 182 days only. So if they are in India for 181 days, then they will be non-resident. If they are in India for more than 181 days, that is 182 days or more, they will be considered as resident. So this is very important aspect. Then the amendment here is that if a person earns more than rupees 15 lakh total income other than foreign income, then and only then this 182 days shall be reduced to 120 days. So now there are two parts of this section. If you are a person who is earning less than 15 lakh in India, then you have only two components. Either you can be a resident or you can be a non-resident. But 20 days, then you are a non-resident. If you are staying in India between 120 to 182 days, then you are a RNOR. Now this is also a new insertion in Finance Act, which we will discuss later. It is in section 6(6). And if you are in India for more than 181 days, that is 182 days or more, then yes, as per section 6(1), you will be considered as a resident in India. Now we will move to the next amendment, that is amendment in section 6 of Clause 6 of the Income Tax Act, which lays down the provisions about a person to be considered as RNOR. Now, a person is said to be not ordinarily resident in India in any previous year if such person is an individual who has been a non-resident in India in 7 out of 10 previous years preceding that year. This was the amendment. Earlier, the section says that if you are a non-resident in India for the previous 9 years out of 10 years, or if your stay is 729 days or less in the previous preceding 7 years, then and only then you will be considered as resident but not ordinary resident, whom we call as RNOR. But then in the original finance bill, which was introduced on 1st April 2020, the change was a major one. It was a person will be considered as non-resident if he is in India for less than for 7 out of 10 previous years if he is a non-resident in India. This was applicable to individual as well as this was applicable to a HUF whose manager has been non-resident in India in 7 out of the 10 preceding previous years. The second part of 729 days was done away with. 729 days amendment, 729 days provisions was done away with. It was not kept. Now the second condition, I said 729 days was done away with. Now this was all changed. Now the original part was kept as it is. So 9 out of 10 previous years was kept as it is. 729 days provision was kept as it is, and a new subclause was inserted. This subclause was about individuals who are deemed to be resident in the section newly inserted clause 6(1)(a) and persons who fall under mischief of explanation B, that is 120 days and 182 days to section 6(1). They are deemed as non-resident, as RNOR, resident but not ordinarily resident. So this is a major amendment that was made. Now here there is a very interesting, you can say a loophole, or you can say something adventurous thought that you can have. Now when a person who is deemed to be resident under section 6(1)(a) is considered as a RNOR. Now again, if you go through that section, so I urge all of you, if you have a verbatim copy of that section, just open it. There is very interesting analysis that I am going to share. I don't know if this is adventurous interpretation or there is any mistake in drafting the law, but I'll share with you. Your suggestions and thoughts are always welcome. So, notwithstanding anything contained in clause 1, what I am reading is section 6(1)(a) as amended by Finance Bill 2020. So it's now in Finance Act. Verbatim copy again. Notwithstanding anything contained in clause 1, this is very important aspect. This clause 1 has been overwritten, that is, there is non-obstinate clause. Nothing in clause 1 I have to see now. An individual, yes, an individual. So just a hypothetical example, there's a person X who is staying in India for more than 360 days. So for whole year, he is a citizen of India. Yes, he is a citizen of India. Now, if his total income in India is exceeding 15 lakh rupees, then yes, his total income is exceeding 15 lakh rupees during the previous year, he shall be deemed to be a resident in India as per section 6(1)(a). Now, if he is deemed to be a resident in India as per section 6(1)(a), because there is non-obstinate clause in section 6(1), can we say that he will be considered as RNOR, and that all the benefits that RNOR get, it will be given to him, although he is a resident, because he falls under the mischief of section 6(1)(a). This is a very interesting analysis. I would suggest my viewers that you can have your thoughts in the live chat here, so we can discuss on it more. So with this, I move to the next amendment, that is amendment in section 115 BAC, that is a new tax regime. It was a very important, very interesting amendment that was brought in by Finance Bill 2020, and it provided a lenient tax structure with rate cuts. At the same time, it took away many deductions that an individual would get. Now there was subsection 5 of section 115 BAC, which said about how to exercise this option. Now I will read the act. notwithstanding content in this nothing content in this section, that is section 115 BAC, shall apply unless option is exercised in the prescribed manner by the person. This is our original introduction, that is 1st February 2020. Having business income on or before the due date specified under subsection 1 of section 139 for any previous year relevant to the assessment year commencing on or after 1st day of April 21, and such option once exercised shall apply to subsequent assessment years. So what does this say? That if you are having a business income, then you have to exercise this option on or before due date of filing your income, of filing your return of income, the date prescribed as per section 1, subsection 1 of section 139, and it has to be exercised. It can be exercised in any year on or after 1st day of April 2021 assessment year I am speaking about. But a very important aspect is when once such option is exercised, then it will apply to all the subsequent years. So once you exercise this option, once you go into the new tax regime, you cannot opt out for it except there is a one-time window for it, and this exercise will apply to all the subsequent assessment years. Now what does this window say that I am saying one-time window? Provided that the option under clause 1, which we are reading now about a person having a business income, once exercised for any previous year, then it can be withdrawn only once for a previous year other than the year in which it was of course exercised, and thereafter this person shall never be eligible to exercise option under this section except when such person ceases to have his income as per clause 2 there. So once you exercise the option, then there is no way that you can move out except there is a one-time window. If you again opt for that window, you cannot take the advantage of new tax regime, or you cannot exercise new tax regime structure for any subsequent years. However, there is a second clause for persons having no business income. So if there are persons who aren't having any business income, then they can choose or exercise this option every year. So once they want to continue with new tax regime for a particular year, they can do it. If they don't want to continue, then in the next year they can continue with the old tax structure with all the deductions and a bit higher tax rate. However, there is a very important aspect for you and me as we are professionals. What about professionals? So for professionals, if we read original finance bill, we would think that we fall under clause 2 and we can exercise this option each and every year. So that was really a good part for us. कभी लगता है इनकम ज्यादा है ये ऑप्शन में तो वो ले लो, कभी लगता है वो ऑप्शन में टैक्स सेविंग ज्यादा होता है तो वो ऑप्शन ले लो. बट ना फाइनेंस बिल has been amended to make this persons who are having income from professionals with par with persons having business income. So now what option is left with us who are earning professional income is that we can exercise this option in any previous year relevant to the assessment year commencing on or after 1st day of April 2021. So if I want to exercise the option for 2020-21 financial year, I can do it. If I want to exercise this option for financial year 2022-23, I can do it at that point of time. Between the years, I have to continue with the old tax structure. But once I exercise this option for any assessment year, this option will remain to continue for all the subsequent assessment years. If I want to withdraw, there is a one-time withdrawal option. If you exercise that withdrawal option, a very important thing is that you can never take benefit of this new tax regime ever. So this is a very analytical thing that we need to discuss, we need to understand, we need to study and think the option new tax regime or old tax regime for ourselves, for our firms, for our proprietorships, or for the proprietorships of our clients who mainly have income from business or sometimes profession. So this is a very interesting and important amendment that has been made. Now let us go to the amendment of DDT, that is dividend distribution tax. As we all know that dividend distribution tax is abolished now and all the dividend income shall be taxed in the hands of the individuals who are receiving it. Section 1034, which was a section which provided for exemptions from dividend income in the hands of individuals has been done away with. It has been given a sunset clause from 1st April 2020. Now, this amendment, there was a bit confusion about taxability of dividend on whom there has been dividend distribution tax paid under section 1150. There has been some sort of tax paid under section 115 BBDA. Then what would happen? Finance bill was totally silent on it, the original introduced one. But however, the amended finance bill has taken due care of this query, and they have said that the said amendment will be applicable from 1st April 2020, and this will not apply in case of individuals whose companies already have paid tax under section 1150 or section 115 BBDA. Tax has been paid by that individual. So if your company has paid some amount of tax on this DDT, that is the prescribed amount, or if you have paid any tax under section 115 BBDA, then don't worry, you won't be taxed again. There has been a proper care that has been taken care by amendment to the Finance Bill 2020, which has been now passed. Now, another important amendment is of section 194N. If you go to the original finance bill, you won't find any amendment there. Section 194, section 194N was not amended at that point of time. However, while passing this bill, there is this amendment. What section 194N says? Section 194N, yeah, of course, it speaks about TDS. TDS for cash payments by banks, by cooperative societies engaged in the business of banking, or a post office at the rate of 2%. So, cash payments by banks, a cooperative society engaged in the business of banking, or a post office at the rate of 2% if the amount of such cash payments, that is the cash transferred, that cash withdrawn by individual, is more than 1 crore from one account or many accounts. This was the original 194N. There were a few exceptions to it, but that remained the same. Therefore, I won't discuss that. Now, there was an important amendment to it. If such a recipient of cash, that is a person who withdraws cash from banks, post offices, or cooperative societies engaged in business of banking, and if they have not filed return of income for previous 3 years, then these rates changes. Now, the new rates that have been brought in are amounting to rupees 20 lakh to 1 crore. So any amount withdrawn in a previous year in between 20 lakh to 1 crore, then 2% TDS will be deducted. If more than 1 crore, then 5% TDS will be deducted. So for a person who has not filed his income tax returns for previous 3 years, this amount goes up. TDS rate goes up. The limit of amount also decreases. Now it's a very important task for all these banks, post offices, and cooperative societies engaged in the business of banking to collect data of persons who have not filed a return of income for previous 3 years. Also, there is a very important part on us. Many times there can be such cash withdrawal of our clients or of our own selves, which would have been earned through exempt income. Then, according to my analysis, if there is a withdrawal of more than 20 lakh, 1 crore, as the case may be, and if there is TDS that has to be done by banks, this cases probably will go under assessments. And then we have to have a proper, genuine, and a neat answer ready to convince the officers that this was out of exempt income or it was a genuine amount which was not liable to tax, and therefore the person was not liable to file any income tax returns in the previous 3 years. So this is a very important aspect that we need to consider. We need to ask our clients to tell us each and everything. And also, if we have clients of banks, post offices, or cooperative societies, again, this data collection work has to be done promptly. With this, the major amendments, the significant amendments, we will come to that amendments in a later video. Amendments regarding equalization levy is a very important one, but we will have a separate chart. Finance bill, that is about section 44AB, a very dear and near section to us because it speaks about tax audit. Now, what 44AB was amended that provided that in the case of a person whose aggregate of all amounts received in the same thing was with the payments for the expenditure. If expenditure in cash do not exceed 5% of such expenditure, then the limit as specified in 44AB of rupees 1 crore was shifted to 5 crore. Now, an important speaks about presumptive taxation. An eligible business in this case is a person who is earning income below rupees, whose receipts are below 2 crores. Now, here, if I say there's a client or if there's a person who has for 1 crore or 5 crore, then what will be the interplay out there? Suppose a person is earning an income of rupees 1 crore 99 lakh 99,000. Then, as per section 44 AD, he has to compulsorily show his income at above 8%, or if it is below 8%, then he has to have audit done, tax audit done. Now, what if a person has followed all this, that 5 crore? Now, if his receipts are more than 2 crore, say 2 crore 1 lakh rupees, then section 44 AD will not apply to him, and therefore, according to me, there is no bar on him to get a tax audit done if his income is below 8% as prescribed in section 44 AD. So, for this 2 lakh rupees, there can be either mandatory audit if the income is below 8%, or there is no audit if the income is below 8% if your receipts are more than rupees 2 crore. So this is a very important aspect that also we need to think on, we also need to analyze, and we need to advise our clients accordingly. Now the next thing, TDS provisions vis-a-vis section 44AB amendments. Prior to these amendments, what TDS provisions, majority of the TDS provisions say that the threshold limit to apply TDS provisions would be turnover as per section 44AB. However, now this has been done away with, and now there have been particular figure, that is rupees 1 crore for business and 50 lakh for profession. So, if a person who has the limit of 5 crore for tax audit because of his following of these conditions, still we need to keep in mind that TDS has to be done, whether or not he is in bracket of tax audit, because now the word says that TDS has to be done if the receipts are more than 1 crore for business, or if the receipts are more than 50 lakh for a profession. So these are few important aspects that I had to discuss with you. Section 6, then we discussed 115, we discussed about DDT 1034, 115 BBDA 1150, that amendment. Then we discussed with provisions of section 44AB, then 194N. So these were important aspects that I had to discuss with you. There will be many more seminars that will be coming, webinars that will be coming. I thank you for this huge response. Before I conclude my session, I would like to announce our next webinars through Professional Forum that we will be conducting. The next webinar shall be conducted by CA Yash Goyal on the topic TDS and TCS provisions under GST law on Wednesday, that is 1st April 2020. And the next one by CA Bhunesh Kankani on penalty under section 271D, read with section 269SS and 269T. The next one will be by CA Nagesh Jadhav. He will be live on YouTube on current issues under GST. For matter that you want to have a live webinar with, or you want to have a video uploaded, please ping to our chat box. The mail ID and the number will be shared here with you all. Stay updated, stay tuned. And before I conclude, I want to give or I want to ask you all, I want to make an appeal to you all. In this midst of coronavirus, it's very dangerous to go out. If you don't have any essential work, please don't step out. I also urge you that now there's a possibility that we are going into third stage. There has to be a big infrastructure that we need to set up, and for that our country needs funds. And for that, yesterday our PM Narendra Modi has established a PM Care Fund, and also our ICI President Shri Atul Kumar Gupta has had prepared a ICI COVID-19 fund. So I urge to all the members, to all my fellow viewers, to generously contribute Let us stay together. Let us fight this disease, and let us stay safe. Let us enjoy these knowledge sessions more and more in the coming days. Thank you.